want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to the DIY Investing Podcast. My name is Trey Henninger and I'm your host. This week I have a special guest on the show, Tim Eriksen from Cedar Creek Partners. Tim has been a MicroCap hedge fund manager for 13 years. Tim, welcome to the show.
Thank you for having me.
So Tim, what I want to ask you first is, how did you first become interested in investing? So what's your background?
Wow, the short story. While doing my undergrad, I had a class on money and banking, and this is like 1990 or so, and it just fascinated me at the time. That's when Wells Fargo was going through all their mess and with California real estate, and I just had a prof that was a value investor, and as he just kind of explained stuff, it just the light bulb went on in my head. I understood it, and just really wanted to dig into it. And I'm like, wait, I'm graduating with a history and a poli-sci degree here, but I know this is the direction I want to go. So that sent me on a long journey over the next 10 or 15 years before I actually got into the industry. I worked for a while and then went to Texas A&M to get my MBA, figuring, okay, if I get my MBA, I can get into the investment field. And that didn't really pan out the way I thought. So I just found job in just private sector, doing construction and administrative engineering jobs and stuff for Peter Kiewit Sons. And then along the way, found a site called Marketocracy, which was helping, where you could set up virtual portfolios and see, are you really, a good investor or not? And I kind of had to do it to find out, hey, do I follow my dream or not? I think I can do this, but, just telling somebody you think you can do it's not going to get you a job. So see if you can actually manage money, even if it's virtual, take it seriously, do the research and see how you do. And so I started that in 99 to 03 and did really well, which was allowed me to kind of get some publicity and kind of use that as a track record to begin raising capital.
Okay, so it was working through this website where you really got to test your investing acumen. Had you been investing your own money before that?
A little bit, but like many people, I didn't have much. So
yeah.
It was kind of like, hey, I had enough money to buy a stock, and how would that go? That was more of my life at that time.
Yeah, so I think it's interesting. Do you think? So you started out managing, kind of this virtual portfolio, and now you've transitioned to managing money professionally. Did the virtual portfolio help you in terms of understanding really the behavioral aspects? Like, did you feel the same like angst you might feel that you would if it was, all real money?
I think so. I think it was really helpful in terms of my own emotions and how I would respond, because at that point in my life, that was kind of the dream I had, to do. And I kind of felt this was like my only shot at it. As like, I got to do this and do this well. So when the performance started to wane at any time, it would weigh heavily on the emotions and oh, can I actually do this? And you begin to question yourself or whatever, or just, market things happen, or, you just have an event in a stock that just happens. And even if your analysis was good, you just couldn't foresee something happening like that. And dealing with that was, I think, immensely helpful to kind of be able to do that in a sense, in a simulation, for then when I was actually, managing real money.
So yeah, I was just curious because do you know that, that was right during the .com bubble, basically. So did you experience that bubble in terms of like, how did your returns work out over that 1999 to 2003? Do you remember?
Well, as much as you had that bubble going on, that was probably the best era for value investing. That's, I don't even know. And in my lifetime,
Yeah.
99 to 03. I mean, in that virtual fund, I was like 35% a year. I mean, it was just incredible. Too incredible. I probably thought too highly of myself at the time, but
yeah. Okay, so you've been a value investor the whole time then. It's not been starting something else into growth and then transitioning into value.
Right. No, it hit me from the beginning, in that class in 1990 and has kind of stayed with me.
So then you focus on microcaps. Is there any reason that you prefer microcaps over other stocks?
Well, and a lot of people talk about this, and it's certainly true, is that really historically microcaps have outperformed large or mid or even small caps. So that's one reason, is like, why not go to where you have the better opportunity set? And I also think there's a couple other reasons. Is one, they're easier to understand. I mean, it's a whole lot easier to look at a community bank's SEC filings than to look at Wells Fargo. I mean, I've been doing this for 13 years as a hedge fund, and I look at somebody like Wells Fargo, and my head begins to spin trying to sort through that 10Q or 10K. But the smaller stocks are just so much easier to understand. The filings are shorter, business is simpler, and then you add to that the inefficiency in the market, because all these bigger analysts are only going to cover something that has enough trading volume for them to make money or be big enough to move the needle for a firm that's managing in the hundreds of millions or in the billions of dollars. It's just a neat little niche. It tends to be slower to incorporate information because you don't have all those analysts and maybe even all the investors following it. Sometimes news comes out, and instead of it being priced into the stock in seconds or minutes, it can be days or weeks. So it's just my favorite niche. I didn't intend when I started out to go there, but I just kind of love the microcap space.
Do you think that can, what you just said there about it being slower to incorporate information, do you see that as an advantage or a disadvantage? The reason I ask is because sometimes, as value investors, we make a lot of money off of mean reversion. And so if it takes longer for that mean reversion to occur, could that harm your return? Or are you just trying to use it to, find ways that you can take advantage of it longer? What are you looking for there?
No, it's a great point. I mean, I think if you already own the stock, it's a little frustrating because you're like, the news is right here, people, see it. And being patient, waiting for that to be incorporated into the price can be frustrating. But on the other side is if you're not already in the stock, you can read about something and it's not too late. A lot of times you read, oh, that's attractive. And you're like, yeah, it's priced in the stock. It's already up 20% today or whatever. And the microcap, sometimes it's like, no, that it hasn't even moved. And so it allows you to be coming in and to buy. So depending on where you're at in the situation, it can be a great benefit or a little frustrating.
Yeah, no, that's definitely true. And so the other piece that you had mentioned and what you were saying on microcaps, though, is that they're, a lot of times that they've outperformed larger companies. Historically, do you have any concern that could change with the way, you have these market darlings now that are basically platforms that are taking over the world in terms of like the Amazons, the Apples, the Google. I mean, do you have a concern that these super mega caps that are taking market share from many, many small companies threaten the historic performance of microcaps? Or is that not part of your process?
It's certainly possible. But I mean, if the market gets dominated by bigger players, at a certain point, there's niches that they just don't care about. So just as I kind of pointed that out in investing, that you have the smaller stock isn't something that the large firm analyst is going to look at. I think as you get larger companies, they're not going to go into an area that's really small. They're not going to go into a little niche that's $5 million or $10 million of revenue, which allows these little companies to play in that space. So I don't think it'll hurt the really small end. I mean, it can certainly, I think it would hurt the mid and the small caps more.
Yeah, no, that makes sense. It's the story that I see, and it's always important, I think, to see both sides of the story. And that's what I hear when I talk to people about my own microcap investments is like, well, what about Facebook? They're growing 40%. Why don't you own the large companies that are taking over the world? So when you look at portfolio management and you're doing your investments, how many stocks do you like to own? And is there a reason for that selection?
Yeah, there's definitely a method to it and a reason. I guess I hold more of the Buffett and Munger belief that excessive diversification will just lead to mediocre results. So I want to have a fairly concentrated portfolio. My top 5 are going to be about half of the portfolio. I'm probably going to own 20 to 25 names, but the last 10 names or so are probably in aggregate, about 4 or 5% of the portfolio. They're either things that just didn't get enough liquidity and yet they're still attractive, or they're just kind of things you're keeping your eye on, and it's better to have a little bit of a position to do that. But so generally it's putting, your money into your best idea, trusting your analysis, and instead of just saying, I'm going to equally distribute this. Well, on however you look at that, if someone was doing it among 50 names at 2% each or 20 names at 5% each, it's like, I'm of the position, it's like, you need to be able to distinguish out of those 20 or 50 stocks, which one you like the best, which one's got the biggest discount to intrinsic value, which one is more likely to move up in the near term, and weight that one more heavily will improve your returns. So.
Okay. So then when you have that kind of ranking in your head or written down to look at, okay, these are my favorite stocks and these are some that are really good, but they're not as good. What would be the process for when you sell stocks? Because that's the part that I struggle with sometimes is that, it's relatively easy for me to identify the companies that are worth buying, and it's harder to know when to sell. So what causes you to sell a company?
A lot of different things can cause me to sell. Even on the positive side of something being just immensely more attractive, then I'm going to reduce the one that, it still may be good and attractive, but it's not as attractive. So it doesn't even necessarily have to reach intrinsic value to where, a lot of people say, well, we just hold it till it reaches intrinsic value and then we sell. It's like, sure, I guess if you have that much cash on hand when you find a good idea that you don't have to sell at something to buy it. But for me, if I find something more attractive than I'm selling, if I tend to be an early seller, I'm not trying to max everything out. My fair value estimate, which I don't even, make a big deal out of it when I'm investing, but I kind of have a general target and I'll sell on the way. I don't wait till it gets there. With microcaps, especially, liquidity kind of just comes and goes. It can disappear for a while, and when it's there, I tend to sell into it if it's, so even with a lot of microcaps, right after earnings, there tend to be a lot more volume. And if, that's when I tend to lighten up and then kind of buy when it's kind of in the drier period when it's boring and they're not hearing any news for 3 months. But so in general though, it's like, I try to buy single digit PEs, single digit price to earnings ratio, and really just sell it at what I think is reasonable for that business. For some of them, it may be 10 times earnings. Another one, it may be 15. But nothing at an outrageous price before I'm moving on.
Gotcha. So you're not just always trying to maximize it. You're just finding new ideas enough to kind of turn the portfolio over.
Yeah, I've used the illustration of kind of like retail sales is our, and everybody can do it a different way. I mean, you can kind of be the high margin and fewer sales to where you're just trying to hold that thing for a long time and try to get 2 times, 5 times, 10 times, whatever over decades. I mean, someone can do that where they're just selling very rarely and follow maybe Buffett's punch card idea of only 20 purchases in your life. I kind of a little more of a quicker retailer that's turning it over. I'd rather make 20-25%, turn it over, do another 20-25% or something in a stock than trying to say, you know what, I got to hold out for this 5-bagger or 10-bagger so I can brag about having a 10-bagger. It's like, I don't really care how many stocks I have that go up 10 times. I'm just really striving for the highest average annual return I can get and being tax efficient along the way is my goal.
Gotcha. No, that makes sense. So with regards to when you're trying to select those companies, what is the number one thing you're looking at when you're trying to buy a company? You said you like to be focused on your best company, but what are you looking? Are you deep value, quality? Besides MicroCap, what are your top 3 things you're looking for?
Well, the first part, I mean, as I said a little bit earlier, is I tend to be a PE multiple investor, price to earnings. So not that I won't buy, something that's just deep value, net nets or something that's trading below net current asset value or liquidation value, or even something that there's investors that just look for a low price to book. I'm looking more at companies that have stable earnings and growing earnings. Most of my mistakes are with companies where you have kind of earnings decline and I underestimate how quickly that could erode, and that turns out poorly for me when I make those kind of mistakes. So something that's stable and it kind of a little bit depends on the market. Like right now, I mean, stable is kind of punished. Everybody wants growth, so they pay up for something that's growing, at 15% a year. But something that's either stable or growing 2 or 3% is considered unattractive. But at the right price, you still can get very good returns. And we all know the danger for the growth guy who expects 15 or 20% growth, and suddenly they only get 5 or 8, and then that stock's going to get cut 30, 40%. So, everybody has a risk to their style, but you try to minimize it. So you also, you're always looking, is there debt risk? What could make this turn out bad? And watching for those things, but not being so scared of those things happening that you don't do anything.
So do you perform discounted cash flow valuation to determine your intrinsic value estimates, or how are you determining the intrinsic value?
Yeah, I don't really do a discounted cash flow because I think in reality most of the numbers are kind of made up and those move the needle a lot of what your discount rate is or what's your terminal value and what rate are you using there and growth rates. I'm more of if I see stability and growth, just modest growth, I can kind of just look at the last, say, 3 years of financials or 5 years of annual financials and go through the quarters. And then I kind of project out a few quarters or a year or two, but I don't, I think through, will this business change in 5 or 10 years? But I don't sit and try to run the numbers of 5 or 10 years out to see that to create a value. It's more of what is the value of the current earnings stream with the belief that the earnings stream is stable or growing.
Okay.
Which is why I probably struggle with being a growth. I rarely buy anything that's growth because I have such a hard time, allowing myself to say, well, let me grow this at 20% on the top line and see what that does to the bottom line net income and then discount it back at what rate and come up with some value. And I can't can't get around. I can't do it.
So basically, you'd buy a company that's growing at 20% a year if it was a PE of 8, but it's a lot harder for you to justify a PE of 20 or 30 or something.
Yeah, or 40. Yeah. It's. I mean, I don't. And that's the thing. It's not that as a value investor that I don't like growth. I love it. I just have a hard time valuing it with any margin of safety and comfort level. I mean, I have bought companies that were in a growth, state of 20% of revenue or earnings and done that at single digit multiples. And that's, the doesn't get any better than that.
Then it works great.
It's great. I'd love, if you got a name, I'd love it,
Yeah. So I think this is a good point to transition to some stock examples. When we first talked about doing this podcast, you had reached out specifically about Beaver Coal doing a follow-up. We talked about it in a previous episode 48 of the podcast. And so I'd like to just start with Beaver Coal. If you give me just a little synopsis. It is my understanding that you own some stock in this company.
Yeah, my fund actually owns a little over, I think, 1% of Beaver Coal.
So the big reason that Beaver Coal was interesting to me when I first heard about it in my interview with David Flood was that it has a dividend yield. Well, right now I'm reading about 14%, but I think it's ranged between 14 to 20% or more, depending upon the stock price in the last year. And so the big question for me was, is that dividend sustainable? And I'd be interested to hear what your thoughts are on that.
Yeah, and it was interesting. And I read David's blog, and I think that I had saw the article, and it was only in the last maybe 6 months I'd seen his article on. That's when I came across his blog in the last 6 months. But I saw his article on Beaver Coal, and I was like, that name is familiar, and it's actually an old Walker's Manual. A stock that was in Walker's Manual, and I worked for Walker's Manual for a couple of years back in 04 through 06. And I remember seeing it in a couple of the books that they put out at the time of just of unlisted stocks. So I knew that the company had been around a long time. I could pull out the old manuals and I could see the dividend rates from the 90s. I could go on OTC markets and see the dividends in the last decade or so. So I knew a lot more about the stability of the company when I was reading it. And then, the importance of really reaching out to management is that I reached out to the company and, hey, can I get annual reports for the last 5 years? Oh, sure. So they emailed me the annual reports for the last 5 years. So then I could, get even more detail, see what the revenue, what are the revenue sources, what's from their coal royalties, what's from gas, what's from timber, what's from the rentals they have on the 50,000 acres they own in West Virginia, how much is land sales that may not be recurring, are there any unusual items on the revenue side or the expense side, and really getting some detail there. And then, I did a follow-up where I reached out to the company and said, I just, I wanted to had some questions about, the main revenue source, which is their coal royalties. And they had jumped in the last couple of years. And that's why the dividend for Beaver Coal had jumped in 2017 and 2018 up to about $200 to $220 per unit. And so doing research on that, they're like, oh, okay, well, one's a lessee with Arch Coal, which is a listed stock, and then another one is with a Ukrainian company had purchased the mine and uses it, a company called MedInvest, and just started up production. But so it kind of led me on this investigative path that I love with microcap stocks. So I started digging in Arch Coal's presentations and in their filings, looking for what they call the Beckley mine, because I wanted to know, hey, is this sustainable? Because all of a sudden revenues jumped in 17 and 18, but how likely is this? Well, you can go into Arch Coal's 10K, and I found the Beckley mine, and it's producing a million tons every year, and it has reserves of like 26 million tons. So I'm like, wait, this has got a 26-year life. suddenly then I was really excited about this stock yielding, at the time, whatever, nearly 20% or in the high teens. I was really excited about it. I'm like, okay, so this one mine has definitely got a good life. It's not thermal coal; it's metallurgical coal, which is significant because margins on thermal coal stink, and coal as a power source is certainly under attack and being moved away from as we move to natural gas and renewables. But met coal is necessary for steel. So I'm like, this has a much more stronger likelihood of being around 10 or 20 years from now. Then looked at the other mine that was going that Medinvest, the Ukrainian company, has, and it was hard to find details about it, but United Coal is their company, and it talked a little bit about production. I could find that online and search for them and kind of piece together that it's really a vertically integrated company. Medinvest does steel production in Ukraine, so this is really a way for them to source their own met coal, which I think creates more stability in that. It's hard to get as much details about reserves, but when something just starts in the last few years in a coal mine, you don't do all that capital expense. At least I've never seen a huge amount of capital expense for a 5-year mine life. It's almost always 15 to 25-year mine life. So I felt very comfortable with what future revenues could be. They even actually have a third mine that's not active, but is also met coal, so it could start up. So you even have the possibility of additional revenue in the coming years. So I was just really excited when you have a chance to get something at a high teens return. I was excited, so I started buying 3 or 4 months ago.
Okay, so some really interesting information. So Medinvest, you think that they are shipping the coal to Ukraine? Is that right?
Yes, which is not unusual. I mean, a lot of the met coal out of West Virginia and Virginia goes out the ports of Virginia, so and heads towards Europe for steel. So that how it gets all the way to Ukraine, I don't know. Or even if they're using it as a nice way to hedge. If prices go up, then they sell theirs more, and they're swapping out somewhere along the way. Whatever their method is exactly, I don't know, but felt very comfortable with what they're doing.
So metallurgical coal is different than I mean, I don't know a lot about metallurgical coal other than that it's chemically different. So is there any alternative to metallurgical coal for the production of steel, or does it have to use coal? Do you know?
Not an expert on it, but I've not come across any alternative that was more economical.
Gotcha.
And the beauty thing is say a thermal coal in that area of the Appalachians, you can look up prices and say, oh, okay, depends if it's central or northern. It can be $40 or $65 a ton. Whereas met coal can be $100 to $140 a ton, and the cost to get it out really it doesn't change based on the type of coal significantly. Most companies I've seen, even I was reading Contura Energy's filings yesterday, a little bit of that. I mean, and their cost of production may be in the $70 to $80 a ton range, but if you're selling at 100 and the spot price is 130 to 140, you have much bigger margins there.
Okay, so you can justify shipping it.
Yeah, totally. And you need a certain type of coal. It's only in certain places of the world. You can't just use Powder River Basin coal from Wyoming and Montana. You have to use a certain coal. So that with the met coal.
Gotcha. I mean, because when you read the Beaver Coal annual report and their website, it talks about how they have the highest quality metallurgical coal. They don't have thermal coal. They have, and that provides them some protection. So you just agree with that. It does provide them protection from the potential declines that are taking place in the coal market today.
Yes, correct.
Gotcha.
And that was the other thing too of even reaching out to the company. Then he sent the letter that they sent out annually. He sent out the last year's letter so I could kind of read through kind of management's perspective on things and see how they're talking or explaining things. So.
Is that the 2018 or the 2017 letter?
2018 letter.
Okay. Do you mind sending that to me? Just curious. I have the 2017 letter, but I haven't read the 2018. Or
okay. Well, I don't have the 17, so we'll swap.
Yeah, we'll swap then and see.
That's one of the things in investing that you find friends and you know. Well, we're not probably going to talk about sourcing ideas, but one of the best ways of doing that is kind of friends passing on what they've kind of, I bought all that I can or want to own, and they pass on the idea, and you're swapping ideas. And so I'd be more than happy to send you that 18 letter.
Yeah. Well, it was just interesting because the 17 letter talks about a decline. They think that the coal revenues are going to decline, and then the 2018 financials prove that out. Not substantial, but that they were smaller than 2017. So I was just curious how they were projecting the rest of the.
Yeah, they didn't give a projection for. I think they said 19 would be higher. But yeah, it was like 5.7 million in 17, and then like 5.3 and 5.3 million in 18.
Yeah. Well, and that's a huge thing when you compare the fact that the coal royalties were at like 1.4 in 2016 or something like that. So they had a huge jump in terms of revenue. So it does. The company sounds very interesting after talking to you about this, because I think my biggest concern, it wasn't coal specifically, because I don't know how much you've listened to my previous stuff. I've talked about NACO, North American Coal Company, and of course they're a thermal coal company that I own. But just understanding that sometimes you have these companies with dividends that get cut. They like to cut the dividend about 6 months after I buy the stock. I don't know if you've had similar experience, but that's always my big concern when I see a company like this with such a high dividend.
Right. No, it's, you certainly, a lot of new investors make mistakes. They see a certain dividend and assume, oh, this is going to keep happening. And you really got to dig in to know, is this a one-time distribution? Is this a normal? Is there enough earnings coverage for the dividend at that level? Because a lot of value people they're trying to do it really quickly. We'll see a company that's got a low, like this high dividend yield, and it's really soon to be cut because the company's under stress, and that's gotta get cut.
Yeah.
So yeah, a lot of people do make that mistake.
So you said, did you get to talk to management then? Did you ask them anything else about their future plans with non-coal expansion? So it sounds like they have those two mines, but they're doing a lot of other stuff on the property. Did you look into any of those other businesses to understand them, or was your primary focus just trying to understand if the coal was sustainable?
Being the biggest chunk of revenue, that was my highest priority, was the coal. I think their website and everything kind of gave me and the letter gave me a good feel for the timber and the gas in terms of the level of revenue those can generate. Gas revenues have been down because of some litigation, and then they had a litigation settlement in 2018, and then they in the letter point out that they expect gas revenues to kind of at least production to go up. I mean, prices still stink for natural gas in the area. Their rental income has been steadily growing, at least in the last 20 years. It's been kind of flat the last 4 or 5. They have a big storage facility, self-storage facility that they have. You can read about in the annual report, as well as just where they lease land to mobile home park or to businesses, which is good because that creates a good amount of stability. When you look at real estate like that should be able to grow over time. So at least above inflation. So, I don't have to do a precise, like discounted cash flow, but I know I'm fairly well covered on the rental income and even the timber income is really kind of at a more of a trough right now. So that could have some upside down the road. You want to know, are they cutting more than the growth is each year? And they mentioned that they're not. So that's important, and those type of things.
Gotcha. No, it seems very interesting. Do tend to reach out to management for each of the companies that you invest in? Is that a common part, or was it just because they're a dark company and so you have to reach out in order to get the financials?
Yeah, I think you can get the informational advantage, if you would, I think, by reaching out with the dark company, or even just, when you're not sure of something. If you're not sure of something when I read an annual report or a quarterly report, then other people probably aren't sure. So if I reach out and kind of get clarity on that, sometimes it's positive, sometimes it's negative, but it helps me to know, what, this isn't as cheap as I thought, or this is cheaper than I thought, and to act accordingly.
Do you filter what you hear from management? I mean, are you ever concerned that you're going to get the rose-colored glasses whenever you reach out to them, or do you just take it at face value?
Well, I don't take it at face value.
Yeah. That was a loaded way to ask the question.
Yeah,
Sorry.
I certainly have learned that, some management, the gist I got from Beaver Coal was kind of downplaying things. The gist you get from some of the companies is they're kind of acting like a salesman. And I'm not interested in the guy who's is acting like a salesman who's just trying to make it sound the stock more attractive than it really is. I don't see that as a CEO's role.
No, I agree with you. So why do you think they were downplaying things? Or was it just they weren't like salesmen? Like,
there's just companies that they're comfortable under the radar. They're not trying to be listed. They're happy. Yeah. They're not, in their case, it's not whether the price is $1,250 a unit or $1,500 a unit. Doesn't matter that much to them. They're just focused on the distributions each year and growing that. So they're not as, they almost are kind of like, don't like the person who's just price focused in the short term. If that makes sense. They're just, they're looking for long-term partners. I even said, we really want you to hold the stock directly, not in your brokerage account. They much prefer that, and looking for it just being, stable.
So I guess, that's interesting, because when I look at the dividend payouts, they have fluctuated significantly quarter to quarter and year over year. I mean, I know that they change them. I guess, do you understand the quarterly, payouts, or what is their dividend policy? Or is it just, this is how much cash we brought in, we're going to pay out 40% of it or 60%? I mean, do you have some idea of what they're trying to do with their dividends?
I mean,
because it's not the same amount every quarter is my point. So,
right. Yeah. I didn't get into specific questions on, is it an exact percentage? I mean, in the long run, they're matching up, really, in a sense, their distributions and their earnings, because, they're not taxed. You're going to get a K1 and the individual is going to pay tax on it. So although they do a withholding for West Virginia tax, there's like a 6.5% tax there on the distributions. But yeah, I think in general, it's really the earnings from that quarter, and or any, adjustments that need to take place just to kind of have it match out at the end of the year. So you may get unusually higher ones in Q4 and different things.
Gotcha. So they're really just paying it out almost like a trust, where, they have their earnings, they're going to pay it. And then if it was a bad year, you're going to get lower. If it's a good year, it's going to go up. Something like that.
Yes. There's not that goal of where you see it with a public company of, we never want to cut our dividends, so we're going to keep it conservative or try to have it always artificially rising regardless of what earnings do. I don't see any of that going on. It's just like, if we make 240 a unit, that's what we're going to be distributing. If we make 200, then it goes down to 200. If it goes up to 280, we're going to go ahead and pay that versus trying to smooth it out.
Okay.
So
interesting. Well, I think that's really good. Thank you for coming on and helping clarify that on Beaver. So let's dive into some other companies. One company you had mentioned was WCRS. Can you tell me a little bit about this company?
WCRS, or Western Capital Resources, is it's a small company that owns a few different businesses. They're closely related to a private equity firm in Maryland. So a few of the private equity firm's investments have gone into the public company, and it's not 100% clear if that's just because at the end of their time of owning it, if they needed to do something and needed to sell it, or why they decided a PE firm to also have this public vehicle. But they do. This is a stock that trades around $4 a share and not hugely liquid. I mean, some days it can have just a few thousand shares or nothing. And it's prone occasionally to drop 10 or 15% just because someone's selling more than what the bid side is, which, which is nice. I like that as a buyer. I'm willing to sit there and occasionally pick up shares at 325 or something. In their case, they own a few different businesses. They own their bunch of Cricket Wireless stores, and Cricket Wireless is AT&T's prepaid wireless side of their business. So they have about 200 retail stores there. They have a consumer finance side, which is really just a kind of like pawn shop, short-term loans that they do in Iowa, Nebraska area. And then they have a direct-to-consumer segment, which is actually a combination of, I think, a couple of businesses that sell kind of high-end flowers and plants at the bulbs of them. Not something I'm very familiar with. I'd have to ask my wife more about it. But I mean, obviously, people want to, make the outside of their house nice, and they'll buy more expensive tulips or various plants. And this is a company that sells that, sells those products, and has been around for years. What makes Western Capital really interesting to me is they used to own Alpha Graphics, which was a sign maker. They were the franchisor. They own that, and they sold that off a couple years ago, which brought in a lot of cash. So this is a company that is debt free basically, and trading below cash, yet it's profitable, and they still have a second final payment related to that sale that's been in escrow, should come out anytime. It was supposed to be October or November. Another like $3 million. So their cash position, assuming that full escrow payment, would put them at like $4.30 a share of cash, and you're only paying $3.80 to $4 per share for the stock. They have volatility in earnings because certain businesses are seasonal. But even in the last 4 quarters, they earned 14 cents a share, and that's with some charges. So I think of them as a company that should earn, 30 to 40 cents a share annually. Yet they're trading below their cash. So in a sense, you're getting the businesses for free. And there's been insider buying anywhere from $3.75 to $4.25 a share. So when you can buy below what the CFO is, that's always a good thing. So it's an interesting business for those who are especially more on the net, the low price to book side of the spectrum. I think book value is, like $6.75 a share, and they're starting to buy back shares a little bit. And you get a dividend yield. It pays 5 cents a quarter, so you're getting 20 cents a year on a $4 stock. So it's 5% yield. It's a neat little business. I haven't really made much beyond the yield over the last few years, but that's where the patience comes in eventually. They're either going to do liquidity events, or the market's going to catch on that, hey, this should be valued higher. But if in the meantime I earn 5%, that's okay.
Yeah. Do you have any idea how many shares they're buying back, or have they just like announced a buyback? Do you know what the buyback yield would be? I mean, you have the dividend yield. I haven't been able to find it myself, but
in the last quarter, they bought back about 40,000 shares, which they only have like 9.4 million shares. So it was a decent amount, not a massive amount. They bought shares back a couple years ago at $4.50. like 100,000 shares back then. So, that they've been buying at 4 is certainly a positive sign.
Yeah.
I mean, it does. The filing does tell you how much is left. I don't. I think there's like 800 and some thousand left under the repurchase authorization, but $800,000. But I know that's not very meaningful when they have 37 million of cash. They could certainly increase that if they want to.
Yeah. So I mean, but the company's interesting for what you said is you're basically looking at a net that's earning money, right? We're not talking about a net that's burning cash, correct?
Correct. A net earning money and paying a dividend yield is attractive. I mean, having a net that's burning money burning cash can turn out horribly.
Yeah.
It can burn it a lot faster than you think. You want to buy a discount and have that value at least be stable or growing.
Have you seen how the businesses are doing? I mean, you described these businesses. I mean, I owned GameStop at one point, and they owned basically Cricket Wireless type stores, and that business is terrible. So, I mean, are these businesses doing okay? Are they growing, or do you know much about the performance of the businesses?
Yeah, I mean, they break it out. So, I mean, you can dig down to the quarterly results for the cellular or the direct to consumer or the consumer finance. The consumer finance I hate payday loans and pawn stores, but that's what it is. It's not a business I would normally want to have any involvement in. But it's really been stable. They did have a charge back in like 2016 related to it, but it's really stable. I mean, they tend to earn 200 to 300,000 every quarter in that business, and the cellular retail, they certainly made some mistakes back in 2018, which kind of hurt the stock. They expanded into it really fast, and then had some store closing costs where they spent probably $1.5 to $2 million of store closing costs as they kind of they frankly obviously made some mistakes. But in the last few quarters, it's been earning 500,000 to 600,000 a quarter. They seem to have righted that ship. So that's good. The direct consumer is this really bouncy thing because it's seasonal. So like in the last quarter, it lost 600 grand. But the quarter before made 700 and the quarter before that, like 650. It'll have two kind of really strong quarters, one kind of break even quarter, and then one lousy quarter. So the lousy quarters in the fall, because you're not doing as much. They're not doing as much sales then as they start to do in the winter and the spring quarters. People start planting each year.
Okay. So this company is very different from Beaver Coal. So I mean, do you limit? This is a net, right? So do you look solely for nets or solely for other things? Or it sounds like you're open to many different types of companies. You're just trying to find value where you can find it. Is that an accurate way of describing it?
Yeah, I'm open to really anywhere on that spectrum. I'd even be open to growth. I just have a hard time getting the calculation to work. But sure, nets are fine, but I tend to want the ones that are profitable or very minimal cash burn. A lot of times people will look for shell companies, they call it, where you may be having a discount to the cash, and they're looking to buy another company, and those are fine. I'll buy those if I believe management's good at evaluating the business and the cash burn's really low. If the cash burn's too high, it's like, it doesn't matter if you buy at a 25% discount to the cash. If they're burning through 5% of the cash every year, that's not going to necessarily turn out well, unless they make a good acquisition quick, but then they're feeling under the pressure, So you want to see these really low cash burn rates so they're actually acting wisely with their acquisition. Because I think anybody who invests in that space will eventually find companies that made bad purchases. But occasionally they make really good ones, and it's exciting.
So you said this is tied with the PE firm. Is Western Capital Resources the public entity paying fees to the PE firm? Or do you know how that relationship works?
There's a little bit of, I'm trying to remember if they canceled it or not. There a little bit of a management or advisory fee that they do pay to the firm. And I think that's probably, some of that's probably shared,
like overhead or something.
Shared overhead, but there is like a $200,000 quarterly fee that's going out that says management and advisory fees under their SG&A. So there is still that relationship with, I think it's Blackhawk.
Okay, gotcha. So when I look at this company, what I struggle with is understanding, okay, you say, okay, you can buy it, you're going to get your 5% dividend yield. And I agree with you, it looks cheap. You have this company that's trading with a negative enterprise value, which is what all nets are. So it's too cheap. The question is, at what point do you sell a company like this? Because if you look simply on just earnings, it's like, well, maybe $4 is a reasonable price for a company with just okay businesses if it didn't have the cash. But if you have the cash and that business, how do you think about when you would sell this company, or what are you looking for? Assuming you're not selling it because you have a better idea, if you were to just sell it to get out into something else.
Yeah. And I think, my rough estimate of a fair value on a company like this is I try to take, what's the excess cash, say that's nearly $3.50 or $4 a share, plus what's a reasonable price for the earnings of the business. And so I'll back out any, say, interest income that they're getting from the cash, so I don't double count it, and then calculate out, well, what's the business earning, what's the operating income there, what's a reasonable multiple to that. And so it's a case for me is if I can get the cash plus, 8 or 10 times after tax earnings, if that comes out and should come out to say $6 or $7 a share, I have a good margin of safety. And if I had the chance to sell at $7, sure, I'm gonna sell this $4 stock at $7. But I may even start trimming it at $6 or $5.50 just because as it narrows that gap, I don't have as much upside. So why would I want it to be a bigger part of my portfolio as the actual discount narrows? Does that make sense? Because as the price goes up, it's become a bigger weighting in your portfolio, yet it's a less attractive stock as it's going up in value, because this is really just a narrowing of the intrinsic value related to the cash plus the business. If the business itself were growing and the intrinsic value was significantly growing each year, then I have no problem of it being a bigger part of my portfolio.
No, that makes perfect sense. I think that's the key. That's what I was trying to get at, is that, so what you're seeing is when you're managing your portfolio, you have companies that are growing, you have companies that are more, basically what I call it like an arbitrage type opportunity, where you're saying, okay, I think this is you're trying to hit that mean reversion, say it's worth $6 or $7 per share. As you get closer to that, your return is lower. But now at the same time, if you don't trim back, you're putting a bigger and bigger percentage of your portfolio in it. And so the trimming back helps you manage the risk at that moment of, now you have more of your money in a company that's less attractive. Is that right?
Yes. No, exactly. I mean, I certainly want it to be a bigger position if it's half of what it's really worth than when it's only at a 10 or 20% discount. There's no reason to let it ride until you hit all the way to your target. I find that as a bad way to invest. And I've seen a lot of really good professional managers act that way. And I don't think it's wise, because you're not going to get a very good return if you're waiting to get that last little bit. Don't do that. Just, especially if you're looking and you have why hold this when it's already down to maybe 10% below its value when you have something else over here you could buy that's back at 50%? That was kind of the retailing model I was saying. It's like, you know what, flip it, go ahead and sell that one at near full price and buy that discounted stock and keep doing that, especially if you've already had it for a year and you're into the long-term, gains benefit.
No, that makes sense. I think it's where a value investor really has to think about it. Because if you're, say, a momentum investor, you're going to say, oh, well, the one that's going up rapidly or quickly, that's the one I want to keep. But the value investor looks at it and compares to that intrinsic value and really makes the decision that way. So you're not using momentum basically as part of your process.
I'm not using the price momentum as part of the process, right? I mean, if intrinsic value is rising, then I'm always adjusting my valuation. If it's just the price of the shares is rising, that I'm not letting factor into anything other than moving me towards selling, not towards holding.
Gotcha.
So it's a big thing because I really think a lot of investors are, especially value people, they don't like taxes, and it actually hurts their investing a lot. I mean, it's hard to criticize someone like Warren Buffett, but he's immensely better than I am at this. But you sit there and go, why did you not sell Coca-Cola when it's 40 times earnings? It made no sense. And he's had this large position for nearly 2 decades he's got some little paltry dividend off. I mean, it's like, don't let taxes, cause you to make a bad decision. And especially now, tax rates are not that bad. So,
yeah, no, I mean, it's certainly something I've struggled with is that when you have taxes, it's really hard to think about, oh, well, if I just wait a little bit longer, I can have lower taxes, or I don't want to sell because that incurs taxes. But you're not paying taxes on losses. You pay taxes on gains. So if you're paying taxes, it means you're making money. It certainly would be nice if you didn't have to pay the taxes, but if you need to sell a stock because there's other opportunities, you shouldn't let the taxes get in the way. So let's move on to the next holding that you have. It's PIOE, P10 Holdings. Is that correct?
Yes.
Yes.
P10 Holdings it's an interesting business. It's private equity. It's kind of an unusual name, but a hedge fund manager and some of his partners in the Dallas area kind of got a hold of the company. It was basically pretty much a shell company. Didn't have much going on a couple of years ago, and then they put some cash into it, and then made an acquisition of RCP, which is a private equity firm based out of Chicago. So they agreed to buy them in 2017, issued shares and debt to RCP in order to buy. What was interesting, they didn't buy all the business of RCP. They bought, in a sense, the rights to all the management fees, the base management fees, not incentive fees. So RCP, in a sense, sold the base management fees, but retained the incentive fees. So P10 is basically this private equity manager, and so in the last year they've made this acquisition. RCP probably manages about $7 billion in assets, and I'm a big fan of asset managers. It's an industry that's struggled in the last few years just due to passive investing, but I've made good money in Diamond Hill and Hennessy Advisors, and made more money there than in any other industry. And private equity is a little different because in this case, you only have the money for so long. Usually you have like this 10-year time period, and then the money goes back to the investors, whereas a mutual fund manager, could have it forever. But on the other hand, with the private equity, you're locked in for that 10 years, whereas the mutual fund, some of them find out the money can go out the door really fast. I mean, it could be there only a few months. So RCP you know when they raise money that they're going to collect their fees, and their fee structure is like 1% for the first 5 years, and then 0.75% for the next 5 years. And it's off that base amount that they raised, which is a little unusual. Whereas a mutual fund is that asset manager is going to charge based on the net asset value, how much that's changing. If the AUM goes up because of market appreciations, and so does their fees. Well, with the private equity, that's not happening. It's just this base amount. For them to grow revenue, they have to grow faster than any roll off from the last 10 years by raising money. And RCP has been growing rapidly in the last few years, especially in 2018. It's an interesting business. They raise a few different funds a year, different strategies, and 2018 was a big growth year because they were raising like 3 strategies in the same year, and that happens like every 3 years that they do that, because some strategies they only raise every 3 years, some strategies are every 2, and one strategy is kind of every year or twice a year. So 2018 was this big sweet spot, so it had a really good year. It's a different business too, in that because of the way they structured it, this was a purchase. You have intangible amortization. So they're amortizing the cost of, not directly of the purchase, but of the portion of the purchase that's deemed as not indefinite. So it has a shorter lifespan. So that's hurting their reported earnings, but their cash earnings are significantly better. So like, say the last quarter, this is a company that reports 1.1 million of earnings. Well, they had 2.6 million of intangible amortization. So their true cash earnings, were more than 3 times higher than what their reported earnings were. So it's an interesting business for those who understand the counting of what's going on and are looking at the cash flow. And ultimately, that's what matters. It's not your accounting profits, it's your cash flow that's coming in each quarter. So for $1.30 stock, it has nearly 20 cents a share of about 20 cents a share of cash earnings each year. So it's at a pretty low multiple there. They already have, I think, nearly 20 cents a share of cash. They still have a lot of debt from the acquisition that they're beginning to pay down. But I find it a really, really fascinating business run by some really smart people that I know. I actually went to the annual meeting, and I was the only one there.
Were you the only one there aside from management?
Aside from management. Yeah, of course, management was there.
That's good.
You walk in the conference room and you're like, hey, I'm the only one here. So,
well, that's good. That means that you have low competition for the company, right? If you're,
I love that scenario when you're sitting there and you're like, you don't have to worry about, they're like, what are your questions? And then, they all got your attention, and they're going to answer it. And I was able to kind of, ask good questions and understand the business better than I had from reading their filings. And there's nothing better than that. They've already set aside the time to be there, so you can learn all you want.
Yeah. So here's a question. I don't know if you considered it before. So have you ever considered the idea of being an asset manager and investing in asset management? It's almost kind of like a derivative, because you're backing out multiple times what you're actually owning. Have you ever considered maybe the impact of that or the risks of that, where you're kind of, a few steps removed from the underlying assets that are being owned? Does that make any sense?
I think I understand what you're saying.
Kind of like in the financial crisis, you had these, CDOs where people were investing and betting on not the underlying investments, but on the people managing them and different pieces of it. And it's just kind of trying to understand what the impacts are of that. Because I agree, the investment management industry is very attractive. The types of returns you can receive and the low capital intensity. It's a very strong business. And so it's the business that you're in running your firm. And so it's just interesting to then invest some of that money kind of back into other investment managers. Does that make more sense? Maybe.
Yeah, and there's certainly there's a certain level of business risk that you have doing that. I mean, it's like a bank owning, having I don't know if they bought subordinated debentures from another bank. If they were doing something to where when they're under stress, so is their other investment under stress. So I mean, it can be this double whammy. So I mean, there's certainly some risk there because if when 0809 hits and that investment holding I have is suddenly dropping 30-40%, and maybe I'm getting my own redemptions in the funds I manage, there's certainly a double hit there. So emotionally, it's a lot stronger. It's going to hit you in the gut worse. But I don't let that stop me from doing it. It's an attractive industry with good economics. An industry, because I run a management firm, I understand it. So I think that helps me understand the industry. And that's, I mean, I understand that business a lot better than I understand, Beaver Coal, which seems quite simple, but, I've never owned I never worked in a coal royalty business before, type of thing. Whereas at least I understand this industry. And
yeah, that makes sense. I was just curious, would you limit, because of that correlation risk, would you limit the size of that position in your portfolio because of that?
No, I really wouldn't, but that's just me. If it's attractive, then I'm going to own it. And, I mean, I can back 06 or something. I mean, Diamond Hill was probably 20% of my fund, or 25%. It was a significant percentage because it was growing in the high teens rate, and the PE multiple was single digits, 7 or 8. That it was like there was nothing even close to that. And sure, it's like I could have this risk that the market would take a nosedive, but that it's really kind of short term. Anyways, I'm not one that worries that much about the overall market. I think that I just don't worry about the macro stuff. I've kind of was trained that way, and reading Buffett and Templeton or different people is like, what, I don't worry about it because it's just going to make me a worse investor.
Yeah. So I want to dive in a little bit. You mentioned these amortization costs. Mm-hmm. And the concern that I always have when you remove depreciation and amortization is that a lot of times those are very real costs. So if you're going to pull that out and say, okay, we're going to count the cash earnings of, you said this $2.6 million of amortization costs. Mm-hmm. How confident are you in, why are you confident in that those aren't real costs? Like that won't be incurred again in the future, basically. Obviously, they were incurred in the past.
Yeah, it's very important. I mean, I certainly would not be one to pull out depreciation. You need to look at any business. Look what are their capital expenditures, on an ongoing basis. So don't just add back. I mean, I'm not a fan of EBITDA and things like that. Don't just add back depreciation because it is normally a very real expense. Amortization can be a little different. So sometimes it is a real expense, sometimes it's not. In this case, when they did the purchase, they amortized a portion of it over 9 years. Well, it's not like they only own RCP for 9 years. They're going to own RCP, indefinitely. So when you have an amortization that runs for 9 years and then stops, well, in year 10, they'll still own RCP. And no longer have that amortization. Certainly along the way, they could buy another firm and have the same issue again, but it would be the same thing. It may be this 9 or 10 year amortization. So it's not a real cost that has to be replaced. As long as RCP is continuing to raise money, their revenues are going to be stable or growing, and I can monitor that just to make sure. So in this case, I was very comfortable adding it back in.
Okay, so it's just the purchase cost that, or a portion of the purchase cost, basically, that's being amortized over 9 years.
Correct. Yeah. I mean, there's certain intangibles that are being amortized, and really it was, I think they paid around 170. They had about 170 million of intangibles and goodwill, and about 70 million is being amortized, and almost 100 million is not. But 70 million over 8 or 9 years is a significant amount on a quarterly basis. It's skewing what's actually going on. It's making it look like they're less profitable than they really are.
No, that makes sense. So, but they're not going to lose any rights in year 10. It's not like they have certain rights for 9 years and different rights after that.
Correct. They're not losing any rights. If they were, then boy, you need to look at that, and that amortization is totally real.
Yeah.
If that's all they've done, and occasionally there's companies out there like that. So you have
to. There are.
Read the notes to know.
Yeah. So I haven't looked much at this company, and I was wanting to double check, because when you say it's trading at something like an 18% earnings yield or something like that, if we talk about cash. You said 20 cents on $1.30. That's quite attractive, but you have to make sure that those numbers actually work out.
Yeah, you need to make sure those numbers work out, and then you also have to realize that it's that there's a debt component. If it was debt free, it would really, really be amazing. But obviously, there's a debt side, so you factor that in there as well, and I still come to the conclusion that it's worth significantly more than the $1.30 a share that it's trading at.
How much debt do they have? Or how leveraged are they?
There's about 145 million of debt currently as of the last quarter. It's probably, what was it? It was about at 175 a year and a half ago. So they've paid down around 30 million in the last 6 or 7 quarters. So they're not going to use that cash to pay a dividend. They're going to use that cash to pay down existing debt and to use it for another acquisition, or to seed other investment strategies. In a sense, starting their own private equity firm as well. So
this is going to be basically an acquisition vehicle type thing.
Correct.
Okay.
Yeah, I mean, I think as long as they can find attractive prices. I mean, and that's the thing. I think I've known the CEO for, I don't know, 5 or 10 years, casually. He's more of a friend of a friend, but I understand that investment style, and there's some acquisition companies that they're just going to buy almost regardless of price. Because they're just trying to grow, and that's not this guy's style. He's just very astute, managed money for decades. It's in very good hands. That if they have to be patient, they'll be patient. He actually controls 3 or 4 different public companies right now. Robert Alpert controls Globalscape, GSB, and a couple other companies out there.
And do you know how much of this company he owns?
Well, most of it's owned by the employees of RCP, because when they purchased them, they got almost about half the stock, because I think 44 million shares were in the deal with a 5-year lockup.
Oh, okay, gotcha.
The CEO, which is listed as 210 Capital, I think they own maybe 5% now, because they were willing to issue, or maybe they own about 20 million shares. Sorry, they own about 20 million shares. So about 25%. So that's the thing. There's not a ton of float, because 50% of the shares are owned by RCP principals, and then 25% is owned by the CEO and CFO, and so it only leaves about 25% of the shares as public float.
Okay. So if what I'm reading on Google's right, then they're not levered that much. They're basically levered like a little over 1 times market cap. So you got about debt's half the equity. Or basically debt and equity are very similar, because the equity market's value is at like 120 million or something.
Yeah, using market value, yes.
Okay. Yeah, no, based on earnings, it's going to be a little bit more leveraged, but the market cap and the debt are similar. Okay.
Yeah, some people look at book value versus the market value of it, but yes, yeah. I mean, and the debt component of the enterprise value is about half.
Yeah, but this isn't a company where it's the debt's like 80% of the EV or something like that.
Sure.
Gotcha. Okay. Yeah, it sounds definitely very interesting. So last company I want to talk about today is BWEL. This is Boswell. What I probably
Boswell,
okay.
JG Boswell.
Yes. Can you tell me a little bit about that company?
It's an interesting company. They're very, very secretive. This is a company that's been around for, I don't know, maybe 100 years. They own land in the Central Valley of California. I grew up in the Central Valley of California, so I'm familiar with the area and the land. They own about 150,000 acres, just north of Bakersfield, mostly around, north of Bakersfield. I was going to say it's not Coalinga. Anyways, and they also own water rights in the area for about 400,000 acre-feet of water. And then they own land in Australia as well, probably 70 to 100,000 acres of Australia. And primarily they're cotton growers, but they also are big in tomatoes and a lot of other agricultural products. So there's 1 million shares outstanding. It's about a $630 stock. Pays a $15 annual dividend, so 2.5% yield. Does about $600 million of revenues, and earnings bounce all over the place. But normalized earnings probably at around historically, $10 to $40 a share, with maybe around 25 to 30 as the normal number. So it's a very high PE. But there's certain events that are going on that are unlocking value, I think, in the company.
So when I looked this company up, one of the things that was mentioned is that they were either recently sold a piece of the company, or is that right? They sold something about the cotton gin?
They did. Their operations in Australia are interesting. So it's probably under half of the business, maybe a third of their business is Australia. And they have, off the top of my head, I think 10 or 12 cotton gins there. And like I said, around 100,000 acres. Well, they decided prices were high. They decided to sell their Midkin operations there. That was about 40,000 acres. And I believe along with the water rights and a couple of their cotton gins. So it's maybe, 30 to 40% of their land, only about 20% of their cotton gins just in Australia. And the articles said that the price would be around 300 million Australian, which is about $200 million. So you have this $600 million company that's basically selling about 10% of itself for $200 million. I found that really interesting. I've known of the company for years, owned it a decade or so ago, and kind of jumped back in because I saw them kind of the sale being significant. It would probably move book value up to near $800 a share, so it's selling at a good discount to book, and it's showing you the value of their agricultural operations, which are attractive. That people are willing to pay up significantly for.
Yeah. So, what attracted you to the company? Was it these operations? Because you said you generally try and avoid the higher PE type stocks. So why were you interested in this company then?
Yeah, this is a company where it's really a discount to intrinsic value thing. It's not the current earnings. Just not only the land operations, but the water rights are significant. Their water rights in California have immense value. Now they have 400,000 acre-feet of water a year because their land is adjacent to the rivers, and they've been in the industry for years. So they have these water rights, and they're good water rights. It's not groundwater. This is snow melt from the Sierra Nevadas flowing down like the Kern River. So they have these high quality water, which they use for their farming operations. So a lot of people were like, well, what does it matter? They're not going to sell their water rights, because if they did, then their land just sits there and it's just going to be this dry dust bowl. But they apparently are starting to monetize some of the water rights. There's been some reported activity of them selling about 100,000 acre-feet of water, and just the annual right to that. And if you do some digging on that and look up what Tejon Ranch is a public company, TJR, they own even more land, about 200,000 acres, but it's not as good a land. It's in if you know California's geography, it's just north of Los Angeles. There's the mountain range starts in the Tehachapi Mountains between there and Bakersfield, and they own about 200,000 acres in there. Tejon Ranch does. But they also recently started selling some water rights, and they even buy water from some of the farmers and resell. But the interesting thing is they're selling water rights at about $1,100 an acre, and that's just for the 1 year use of an acre foot of water. Boswell's supposedly going to be selling 100,000 acre feet of water for next year, which, if that's actually at near the $1,100 price range, that's $110 million. That's a significant amount because they don't have a huge cost on that. They should be able to sell that at probably, I think, 75-80% margin, because all you have is some pumping and transportation cost of the waters through the aqueducts and things that are in California. So if you take business that suddenly may earn significantly more money in the coming years now.
So would be, we're talking $70 million in potential operating earnings, not necessarily net earnings, but operating earnings on a company that's only valued at $600 million, right?
Right.
Okay. Yeah, that's pretty interesting.
And that's for just, a quarter of their water, and just, and it's just on an annual basis. It's interesting because if I would think, water has kept going up in price. I mean, I actually had written an article about J.G. Boswell back in 2005. And at the time, I was kind of negative on it. I'd analyzed water prices and different things. Well, water prices are 2 or 3 times since then. They've gone up a lot. And I would bet if they actually wanted to sell the water rights for the permanent right, they would probably get, $30,000 per acre foot of water. I mean, in a sense, the value of their water is this obscene number. I mean, it's like this probably $13 billion or something, you know what I mean, versus a 600 million market cap. Are they going to sell them all permanently and shut everything down? No. So I don't use that number anywhere, but there's nothing that prevents them down the road of doing some longer term sales versus just annually selling 100,000 acre feet. They could certainly sell 10 or 20,000 at a high value if they wanted, and collect significant sums. And they have water rights in Australia, the same thing going on there. I mean, so they can either make it farming or make it with water, and they've always been fairly. Their goal is to make money, not just to farm, regardless. So if they can make more money selling water, I think they'll sell water. They just want to kind of do it quietly and under the radar, so they don't really want the public or the state or anybody knowing they're making good money off their water. But
so this is a dark company.
Yeah, that's the thing that's unusual about them. As much as they're this, $600-700 million company, they're not going to. They don't file on the SEC. They don't file on the OTC markets. They don't file on their website. In fact, if you own shares, you won't get anything from them other than dividends. Unless you call them and tell them that and show proof that you own shares, then they'll send you an annual report, which they copyright. And they're the only company I know that copyrights their annual report. So it is different in that sense. But, they've been around for years. You can read, there's a book called King of California by Mark Ericks. ARAX. That's about J.G. Boswell, which would be the uncle or great uncle of the current president. It's kind of been a family-run business, but it kind of details a little bit of their history and history of that area. But this company has been around a long time, but likes to be fairly quiet. The other interesting thing is they also have they've also planted some pistachios on like 15,000 acres of their land, and those are just now getting to the age where they'll start producing. And pistachios have been grown in popularity, and there was an article even on Seeking Alpha just the other day that believed that pistachios would sell for, I think it was 20 to 30,000 per acre. So just that 15,000 acres, if you multiply that, times the $20,000 per acre, that's $300 million just on 15,000 of their acres. So there's all different ways they could unlock, and that may include some water rights in order to sell the pistachios, because no one wants to buy a farm of pistachios if you don't have water to water the trees. But
yeah,
it's just they have just unique assets. I mean, they also are, because they're so good at cotton, they have their Phytogen subsidiary that has like 70% market share in cotton seeds. They do all kinds of things with getting everything out of the cotton and cottonseed oil. They're just a well-run business.
Well, so I guess so I'm sitting here and listening, and the concern I have is, if these numbers are real, let's say the water rights it sounds like, why farm cotton at all if the water rights are worth so much? Sounds like cotton's a really bad return business. Not like return on invested capital, but return on market value of capital. Does that make sense?
It has certainly shifted in the last 10 years to where, 10 years ago when I looked at it, it was like, yeah, well, why do that? What they would get for the water versus what they were earning on the cotton didn't seem significantly different. But in a sense, cotton prices and their earnings as a company have been pretty flat, whereas the water rights have gone up a few multiples and certainly are trending much higher, to where you're right. Sure, it would make the most economic sense to do that. Could they? Would they? I don't know.
Yeah. No, I know. I'm trying to think through the Buffett mindset, right? It's like, well, hey, you scrounge together $1 billion, buy them out, and then sell the rights for $13 billion.
I think there's probably some fear of, if you do something big like that it would get too much attention. But if it was, I mean, sure, because you think about that, that's $13,000 a share. So, okay, what if you pay 25% federal tax on that? Okay, you still got $10,000 a share. That's 15x from here.
If you can put that deal together, I'll buy in with you. How about that?
Yeah. But it's an interesting company. If you actually did a little, you do historical research, they used to, farm the land and then they would develop the land. Sun City, Arizona, which was done by Del Webb and J.G. Boswell, were the two principals involved in developing most of the area outside of Phoenix in that area. And they've done developments outside of San Diego and things. And they tried to do one in the Valley in Central Valley, and they ran into some issues. But they could find alternative uses for their land in terms of development potentially. They have experience in a lot of things. But you just want to make sure no one does some of the parts and puts a high value on the land plus a high value on the water. And you can only do one or the other. You're either using the water to grow crops, or you're not, and then the land's not valuable farmland anymore. It's just kind of ugly land.
Yeah. No, I mean, it was just interesting, because it's sometimes, I think a lot of times with the agricultural companies I've looked at, is I just wonder that they don't seem to be getting high returns on what you could get that people value land at. and that people tend to overvalue land relative to the capital return they can receive from the actual productivity of the land. And so a lot of these companies will say, oh, let's say timberland. The timberland's worth this. And then, well, the earnings yield on that is 3%. And I was like, well, then to me, it's worth a third of that or whatever,
Oh, I agree completely. There's a lot of people that look at timber companies and value it as if they were going to harvest every tree on there and get all that. And it's like, that's never happening. That doesn't happen that way. So yeah, while it may make sense for an endowment or something to buy at that price, I certainly don't want to.
Yeah.
But here, with the sale of the portion in Australia plus potential sale of some of the water rights here, you're having something where these earnings can I think can move up significantly, near $100 a share type of thing. Plus getting in the 200 million, say from the sale in Australia, which can pay off any debt and give them a significant amount in the bank. So I mean, there's just when you get two catalysts like that, to me, right in the same time frame, that's really attractive.
Understood. So
even though it's a dark company.
Yeah, no, it's just very interesting. The dark companies, you can learn a lot about them, and sometimes find a lot of value because not everything's been publicized as much as other companies. So I think we'll take this time to wrap things up, and I want to thank you for coming onto the podcast. Why don't you share, how you'd like people to get in touch with you, where they can find you, more information, that sort of thing.
Sure. Well, my website's probably it's not even up right now. Anyways, it's kind of going through some changes. But you can reach out to Cedar Creek Partners. My email is tim@eriksencapital.com, ERIKSENCAPITAL.com. Be more than happy to tell you more about my fund or just share ideas. Just love the MicroCap space. So someone's more than willing to reach out to me. And if they're, like I said, interested in the fund, that's great. I can send them stuff. If they're just interested in connecting, that's cool too.
Okay. Well, thank you for coming on the podcast today. I had a lot of fun.
No, it was my pleasure. I had a lot of fun too. Thanks, Trey.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.